What's up everybody, I'm Jaspreet Singh, and in this economic environment where markets are very volatile, where the economy is starting to slow down and where inflation is still very high, you might be wondering where should you be investing your money? The stock market has been having huge swings up and down, the cryptocurrency market has been beaten hard, and real estate is very expensive, and if you don't have access to at least $100,000 of cash, it's going to be very difficult for you to start investing your money in real estate. So what do you do? So what I want to do today is go over 5.5 different ways for you to invest $5,000 today in this economic environment and actually build some wealth with this $5,000 that you're investing. But before we get into number one, I need you to do me a quick favor and smash the thumbs up button below. I'm going to start by talking about the HAF because there's been a lot of talk about I-bonds and a lot of questions about I-bonds in my comment section. So I want to start by talking about that. An I-bond is a type of treasury bond that gives you a return that's matched to inflation. So a bond is a loan and a treasury bond is a loan that you make the government. So an I-bond is a loan that you can make the government, and the return that you get is going to vary depending on how high inflation is. If inflation goes up, the return on the I-bond will also go up. So it's a variable interest rate, and this interest rate changes twice a year. Between now, the time of me recording this video, and October 2022, the interest rate that these I-bonds are paying is 9.62%. Clearly, that is a high interest rate, which is why so many people have been moving their money to I-bonds. Now, there's a couple caveats here. The first thing that you want to understand is the limit of how much that you can invest, because there is a limit. If you are electronically investing your money into an I-bond, the maximum amount of money that you can invest is $10,000 per year. Now, if you're married, you can do $20,000 per year, but per person, $10,000 per year. The second thing that you want to understand has to do with the term, the time limit, because this isn't something that you can just sell in 6 months. I mean, you could, but there are fees associated with that, because typically an I-bond is something that you buy and hold on to for 30 years. Now, you can sell it earlier. You can cash out whenever you want, but there are penalties if you cash out before 5 years. If you cash out after 5 years, there's no penalties, so technically you can sell it anytime you want after that without worrying about any fees. But if you cash out before you own it for 5 years, then there are penalties that you have to pay to take back some of the interest that they pay you. The third thing that you have to understand is going to be interest rates, because these interest rates that you're getting is not consistent, it's variable, it's going to be changing based off of inflation, and if inflation starts to go down, in theory, your interest rate should also go down. And then the fourth thing is the risk. So I personally am not a huge fan of investing my money in bonds because the returns, especially on treasury bonds, tend to not be very good. Now the return here is much higher, but then the second risk with treasury bonds is the default risk. Now, traditionally, growing up, I think everybody has heard that bonds are the safest investment because now you're lending money to the United States government, and the United States government is backed by the full faith and credit of its taxpayers, so you have no risk. But that risk is starting to go up. That's one of the reasons why these I-bonds pay so much more, because there is a risk of higher inflation. Higher inflation means a higher risk of United States government default. Now again, is that risk very high? No, but that risk is there. So it's just something that you want to be aware of, that there are risks associated with these I-bonds, because there's a risk of a potential default. If the government defaults on some of its debts, then you would lose your investment. If this is something that you're interested in, you can go to treasurydirect.gov and buy an I-bond over there. The second way that you can invest $5,000 is by doing something called DCA, or dollar cost averaging your money into the stock market. Because if you have $5,000 and let's say you take $2,500 and you find a good company that you want to own, and then you buy it with $2,500, and then it goes down even further. And now you say, oh, this is an even better buying opportunity. So then you take your last $2,500 and then you invest that into the company, and then it goes down further. Then what? You have no more money to come in and buy, and if you get scared, then you might sell, and now you lose a big chunk of your investment. So instead of just perfectly trying to time the market, which is something that you can do if you're willing to put in the work, but if you don't want to put in all that work, time, effort, and research into investing into individual stocks, the next best thing is to just dollar cost average your money into the stock market. Now, I'm going to be completely honest here. The idea of investing your money in the stock market can be very attractive. It's a hot thing to do, which is why trading is very popular, trading options is very popular, Forex is very popular, because you want to see those quick gains where you want to find a hot company, buy it, and ride it up. But the people that build the real wealth, and I'm talking about real wealth, not just a little bit of money here and there. Real wealth in the stock market are not the traders, it's the people that invest their money over the long term. Now, this type of long-term investing isn't as attractive because it's not as appealing, it's not got that same sex appeal as everything else, but this type of long-term investing is where the real money is built. And if you're trying to do this successfully, instead of trying to perfectly time the market, what you can do is dollar cost average. This is what people hope that a stock chart will look like. They hope that they buy in here and that it's just gonna go straight up. But what actually happens in reality is you have a lot of this. Ups and downs in the stock. And the goal is that over the long term, you start to see this upwards trajectory, but it's not going to be straight up like this. You're going to see ups and you're going to see downs. And so what happens is everybody assumes that if I just buy it here, then I can time the bottom and just ride it up. But it's not so easy to do that because nobody knows when the bottom is. You might see it go down here and say, oh, I found the bottom, and then you come in and buy, and then it goes up, and then it goes way lower, and then you panic, and maybe you sell. So there's no way to perfectly predict that, but the next best thing is, instead of trying to perfectly time the market, is you just try to dollar cost average, which means you have a system where now every so often, maybe every week or every 2 weeks or every month, you're just adding more money into the market. This could be into a certain number of ETFs, stocks, whatever it is that you want. You just dollar cost average, where now it's consistently investing your money. That way now you buy some here, 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 you buy some here. And now you're just averaging your cost basis. That way now you're not buying at the peak, you're not buying at the bottom, you're just averaging cost basis, and then you just keep accumulating more shares over time. And then if you see a dip, well, then you can come in and buy even more aggressively, but you're still buying because you have the dollar cost average system set up. I have a dollar cost average system set up where every Wednesday, once a week, I have some money that leaves my checking account and is automatically invested into a handful of ETFs. So if you have $5,000 to invest, instead of trying to take all of that money and just dumping it in today or tomorrow or next week, hoping that you found the perfect time, break it up into pieces, buy in phases. That way now you can buy on the way down. And even if you don't want to create this type of automatic system where it's happening every week and you want to be a little bit more involved, then what you can do is you come up with a list of ETFs or stocks that you want to own, and then anytime you see these ETFs or stocks fall by 10 to 15%, you buy. If it falls by another 10 to 15%, you buy even more aggressively. If it falls by another 10 to 15%, you buy even more aggressively. So now you break up your $5,000 into a few different chunks, and then you buy slowly, and you buy it at a good buying price. This way you're not chasing companies, but you're looking for that right opportunity. Now, if you're one of those people that wants to be more involved with their investments, you want to invest in individual companies, you want to do your research, you want to do that sort of fundamental analysis because you like it, fine. Just make sure you understand that it's going to take more time on your part and more effort on your part. And if you're looking for some extra resources on how to actually do this type of fundamental analysis and how to find an undervalued company, you can check out Market Insiders. It's an investing education app that I put together where every week you get access to stock market, real estate, and cryptocurrency coaching. You can try it out for free with our 10-day trial. So if you want to try out Market Insiders, I'll put the link to how you can do that down in the description below. The second place where you can consider investing $5,000 right now is by investing your money into startups. Now, this has become significantly more accessible now because of something called Regulation CF, called Regulation Crowdfunding, because it allows non-accredited investors, aka regular people, to invest as little as like $100 into startup companies. Now, personally, over the last couple of years, I started doing a lot more of this type of startup investing in these types of startups because it's fun, it's something that I like working with entrepreneurs, and I like investing in some of these smaller companies because a lot of people don't know about them, and you can see a lot of growth in these companies, but it also comes with the highest risk because these are smaller companies. A lot more of these companies will go bust. I mean, you can look at the statistics, 9 out of 10 startups or something like that go bankrupt. So many of these startups will fail. So you have to understand that there's more risk associated, but the possibility is if you can hit a company, invest in the company before it makes it big, you can also see much bigger returns. There's 3 main platforms that allow you to do this: WeFunder, Start Engine, and Republic. Now, I'm not paid by any of these companies to talk about them. However, I am an investor in the WeFunder company itself. But you can try it out. Look at some of the companies. If you like it, you can potentially invest as little as $100, but just understand the risk, because the only way you get paid is if the company that you invest in ultimately goes public or gets acquired by another company. So it's not a liquid investment. You can't just sell your stake in these companies whenever you want. and you're not going to get paid until this company gets bought out or goes public. So it could be years before you see another penny. The third way that you can consider investing $5,000 is by investing your money in real estate. Now, with $5,000, you're not going to be able to go and buy a whole property yourself, but you can get indirect exposure to real estate, and there's a couple of different ways that you could do that. One way is through REITs, R-E-I-T, and the other is crowd-funded real estate. So let me talk about both. A REIT is a real estate investment trust, and this is something that you can buy and sell on the stock market. So when you invest in a REIT, what you're doing is you're investing your money into a company that invests in real estate. So it's indirect exposure because a company is going out and they're investing in apartment complexes or hospital buildings or office buildings, and then you can go and invest in the company that's buying these companies. Now, personally, I'm not a huge fan of REITs. I like more direct exposure to real estate because now you're also investing in the company. So how good is this company managed? How good is the executives in the company? How good is the whole structure of the company? So you have that potential risk, but you can also see more reward here because you get your dividends very consistently with these companies. But for me personally, I'm not a huge fan of REITs, but some people have seen a lot of success with them. The alternative would be to invest your money into crowdfunded real estate. So this is where now you're investing your money into a fund that's giving you exposure to a property. Some of these funds will give you actual direct ownership into a property. Other funds will give you indirect exposure to a property or a portfolio of properties. So it depends on which crowdfunding platform that you use. But now what you can do is you can invest in some cases as little as $10. Other crowdfunding platforms will require you to invest more, whether it be $1,000, maybe $5,000. Some even require $100,000. So it depends on which fund or crowdfunding platform that you're using. But now you can get either indirect or direct exposure to a property. Now with this, you will get your share of rent and you'll get your share of appreciation. The nice part about this is you don't have to worry about doing any of the management work. You don't got to worry about cleaning toilets. You don't got to worry about finding tenants. You don't got to worry about doing any of that. You have the investor, the developer. These are the main people that are putting together the deal, and they're working to grow the deal and ideally sell it or refinance it. That way they can give you all of your money back plus some. And then you're just investing your money hoping that the fund will perform well. There are a ton of different crowdfunding platforms out there. I have invested some of my own money into Fundrise. They're a sponsor of Minority Mindset. If you want to learn more about them, I have their link down in the description. But there's a ton of different crowdfunding platforms out there that will allow you to invest your money in this type of real estate. Now, of course, there's risks associated with this because if the real estate market falls, well, then you might not see your money back for a longer period of time because they won't be able to sell or refinance as quickly. So you have risks associated with this, just like how you would have risks associated with you going out and buying a whole piece of real estate yourself. But it's a way to diversify your portfolio so you're not just investing your money into stocks or companies. The fourth place where you can invest your money is by investing your money into cryptocurrency. Now, out of the things that I'm going to be talking about, the 5.5 items, this is going to be the most speculative. So if you're going to be investing your money in cryptocurrency, you have to understand that there is risks associated with this because cryptocurrency is the newest asset class, and so it comes with the highest risk. Now, typically, when you invest your money, you want to have kind of a portfolio where you have different asset classes. If you want real diversification in your portfolio, then you would have different asset classes. And this is where a lot of people make a mistake because they assume, oh, I'm diversified because I have my money invested in a blue chip fund and a growth fund and a healthcare fund and a consumer staples fund. And these are all funds on the stock market, whether the ETFs or index funds, it doesn't matter. But the reality is all of your money is invested in one asset class. Paper assets, the stock market. So you have no real diversification because if the stock market crashes, your entire portfolio goes down. So in addition to having some diversification in the stock market, you can also have diversification between asset classes. So this is where you can have things, I'm going to just draw these out like this. You can have things like real estate. You can have things like stocks. You can have things like other commodities. Now, these percentages are going to change. Like you don't want to have a huge percentage of commodities in your portfolio unless you think the world is ending, essentially. This would be things like physical gold. Gold doesn't really produce much value because it just sits there and looks back at you, but it's an insurance piece. So, you got to decide how big or how important is that insurance to you. For me, the biggest part of my portfolio is my business and my businesses. The second biggest piece of my portfolio is real estate. The third biggest piece of my portfolio are my stocks that I invest in. These are the things that I actively invest in and that I've passively invested in. The fourth is cryptocurrency. and then the fifth is physical gold. So crypto and gold are the smallest parts of my investment portfolio, and so you have to first create this type of portfolio here and understand how much risk you're willing to take, because cryptocurrency is going to come with the highest risk. And then if you are investing your money in cryptocurrency, you got to first believe in it, because you're going to have to go through a lot of swings up and down. So you want to make sure that you actually have faith in what it is that you're investing in, because if you don't, then when your investment gets cut in half, you're going to be one of the people that panics and sells because you didn't know what you're investing in, and now you don't believe in it anymore because the price has fallen. I invest in cryptocurrency the same way that I invest my money in stocks, where I have a daily dollar cost average system. Now, instead of investing my money weekly, because cryptocurrency is so much more volatile, I invest my money daily. So every single day, I buy a little bit of Bitcoin, I buy a little bit of Ethereum, and I buy a little bit of some of the smaller coins, and I just let my investments do its thing. I'm not sitting here trying to sell it in the next 6 months. I'm not sitting here trying to sell it in the next 5 years. I'm trying to hold on to this for the long term. Again, is it risky? Absolutely. But again, whether the market goes up or down, it doesn't matter. I'm just buying a little bit more every single day. So if you believe in cryptocurrency, you believe in the technology, you believe in what blockchain can do, then you can consider investing your money here. But again, you might want to consider doing some sort of dollar cost average, because it's going to be impossible to predict when you're at a bottom. It's going to be impossible to predict how high something is going to go, how low something is going to go. So instead of trying to predict when the best entry point is, you can just dollar cost average your way in. And the fifth and final place that you can invest your money is into your own business. Now, this is a little bit different because it's going to require the most time and effort on your part, but it can also come with the biggest returns. Now, a little caveat here. If you're going to be investing your money into your own business, you need to be an entrepreneur. And this is one of those things where you have to be honest with yourself, because there are some people who just don't have it in them to manage people, manage a team, and to really want to build something. If you are not one of those people who are willing to do whatever it takes to make your product a reality, you don't care about building something that's going to solve a problem, you don't care about building a business, then don't go into investing your money into your own business. Instead, you can invest your money into your own craft. Maybe you take this $5,000, you go out and take a class, or you get a certificate, or you do something to get a better position in the company that you are at. That would be a better investment with your money. But if you're one of those people who you say, I hate working at a company, I hate having a boss, I want to do something myself, I want to build my own business, and this is something that you've been thinking about, and you know that this is you, then you can consider investing your money in your own business. I started this channel, Minority Mindset, with less than $100. I started this channel as a hobby because I was already working on other businesses. So this was just a way for me to talk about the things that I love talking about, financial education, investing, because this was something that I never learned about. So I started Minority Mindset as a hobby, with less than $100, and then Minority Mindset started to grow. And then I realized that this could be something a whole lot bigger. So I started investing more of my time and money into Minority Mindset, but it started all with less than $100. And then through Minority Mindset, I have been able to build other businesses, one of which is Market Insiders, which I talked about earlier in this video. The other is Market Briefs. Market Briefs is my daily financial newsletter. So these are two companies that I built through Minority Mindset, and it all started with an investment of less than $100, but I'll also say $1,000, even though I didn't invest anything close to that. But a small investment with a lot of my time, a lot of effort, a lot of ups and downs, a lot of learning. Nowadays, that learning is so much more accessible thanks to YouTube. You can learn anything you want, but it takes a lot of time, and understand that it's going to take you years of effort, but if you're willing to put in the work, this can give you the biggest returns. Now, at this point, if you're wondering, but Jaspreet, we're about to enter a recession. Why would I want to start a business now before the economy tanks? Some of the biggest and most successful companies today were created during recessions. Like HP was created during a recession, Slack was created during a recession, Uber was created during a recession, Airbnb was created during a recession. So just something to be aware of, where it doesn't matter which part of the economic cycle you're in, there's always opportunities for better products. If you enjoyed this video and you want to see which 3 investments you should make right now so you never have to worry about money again, I made a video covering that, and you can watch it by clicking this button right over there. Thank you for watching, and as always, keep hustling. You are your best investment, which is one of the reasons why it might not be as risky of an investment. But the reason why I put it here is because not everybody's meant to be an entrepreneur.